some of these problems, but they haven't got very far. My sense is that by definition, predicting risk in advance is a very difficult task, and it's the very definition of a financial crisis that assets that you thought were safe turn out to be unsafe, and assets that regulators thought were safe completely turn out to be unsafe. So I think there's a lot of work yet to be done there, and here I see the sort of the logic for why the US has moved away to a very simple prescription and an insistence on the overall leverage ratio. And I think there is some merit, some clear important advantages in as much as it's a simple, transparent, and difficult for banks to manipulate, this very straightforward leverage ratio, but completely not looking at the nature of the risk. And the reason why the Europeans are not adopting it is also something I find acceptable. So all in all, this is not an area where sitting where I am without too much experience of the current developments, my sense is that there is a lot more work that needs to be done. I don't think we are anywhere near quote unquote safety. Briefly on liquidity, the approach that Basel III has come up with, I have another 2-3 minutes? Yes. What Basel has come up with in terms of this ratio called the net stable funding ratio, which is ensure that banks have adequate liquidity to cover their outflows for a 30-day period, and the, which is the liquidity coverage ratio, and a second one called the net stable funding ratio, which is to take care of the liability side of the balance sheet, limiting the bank's sort of ability to rely excessively on wholesale funding, which could shut off at a moment's notice, as we saw during the crisis. But here again, my clear sense is that a lot more work needs to be done. I don't have the sort of time to go into details at this stage. With your permission, sir, I'll just use the balance 2 minutes to briefly touch upon India. But before I do that, clearly the global response in terms of specific individual country responses build systemic risk capabilities of the kind that we see. Ila alluded to this, the FSOC and the OFR in the US, BOE in UK being given this responsibility, push trading away from OTC to exchanges, set up resolution capabilities. These are good things that are happening. Enormous discussion globally on central banks and their objective. My understanding of the net result of this discussion is that the world over, the power of monetary policy continues to remain focused on delivering on an inflation target. New instruments, whether in the hands of the central bank or in the hands of the systemic stability regulator, would be created for handling systemic regulation, and it's an additional objective that will be dealt with by the central bank or by the systemic regulator, but this is not an additional objective of monetary policy, as is sought to be sort of claimed in some discussions in India. And to conclude on what Ila had said, clearly post the settlement to the dust, the Indian story of 2008, if it has to be summarized in 2 or 3 words, complicated interplay between NBFCs, real estate companies, mutual funds, Indian MNCs, and currency market. It clearly defied sectoral expertise, and to figure out what was going on, one clearly needed a full financial system perspective, and I think we clearly need to move towards that, and I think that's clearly the attempt of the FSLRC. And in conclusion, what I'd like to say is to quote Ed Balls in a recent FT article when he said, if weaknesses are getting exposed, they must be fixed quickly, which is very different from what we hear in India, which is if it ain't broken, don't fix it. I think we need to fix it now. Thank you.
Thank you, Dr. Krishnan. Before I hand the floor to you, Mr. Amarjeet Singh, just want to add my one line as to what is the biggest risk. There are 3 big risks in the financial sector. Number one is leverage, number two is excessive leverage, and number three is absurdly high leverage. So, you know, it's a game, cat and mouse game between regulators and financial sector firms, how they can build up leverage beyond the amount that would be warranted by the risk capital they have, and the regulator trying to figure it out. In addition to that, what Dr. Patnaik mentioned about AIG, credit derivatives, sometimes regulators don't have the expertise. AIG's credit derivatives were not marked to market in the way they should have been, otherwise they would have known. So it might have been deliberate, it might have been accidental, but the regulator didn't even have the expertise to mark those credit derivatives to market. I don't know whether you've noticed in today's paper, there would be, there was some coverage about Amtech Auto and the corporate bonds issued by it, and JP Morgan's asset management company is delaying or stopping redemptions on some policies. So one was the international aspect, the other is what has happened yesterday. I don't know whether Amarjit you want to talk about that, something which I think SEBI is looking into actively, but over to you.
Thank you, sir, and a very good afternoon. I work with SEBI, so what I'll do is I'll give you a securities market perspective on the the impact of global financial crisis, what have been the implications, what has been the reforms in the global space and also in the domestic space. So basically I'll do three things. I'll talk about reforms, I'll talk about the post-crisis trends, and also some of the challenges, and maybe I'll try and touch upon some of the issues, concerning this JP Morgan issue. Okay, so see how this post-GFC reforms have been played out. There have been four main actors or directors, who are driving reforms at various levels. One is the banking sector reforms, second is the macro-prudential reforms, and third, securities market reforms, and then the insurance sector reforms. And there are respective agencies for each of these areas. For banking prudential, you have BCBS, for insurance, IAIS, and securities market, it is ISCO. So what I'll be doing is, in the interest of time, I'll be focusing only on the securities market side. So what has been the post-crisis push for securities market regulators? As was mentioned by one of the previous speakers, securities market regulators are more familiar with firm-specific regulation. But after the crisis, there has been a push for securities market regulators also to contribute to management of systemic risk, and in the process also review what are the unregulated products, who are the unregulated players, what are the unregulated practices in the market. So basically review the perimeter of regulation, and also look at that the various segments of the market are adequately supervised. The crisis showed two important gatekeepers, credit rating agencies, as we know, who gave inflated ratings at the time of crisis. And when they adjusted the ratings, it was too late. Auditors, we have numerous examples of, the auditors playing a silent role when the financial accounts are fudged. Hedge funds was another area. Another set of intermediaries who were not regulated, research analysts, again, huge conflicts of interest. You may be, as a research analyst, you may be recommending an investment decision to the investors, but doing just the reverse for your own firm. Making derivatives market safer. Here the whole issue was OTC derivatives, and we know, the volume of OTC derivatives had gone up because of complete lack of regulation in US to $670 trillion. Related issue, as a part of the OTC derivative reforms, the push has been that all the OTC derivative trades should be brought to centralized clearing. One, they should be reported. Two, they should be standardized so that, the trading can happen at a central trading platform, and then they should be cleared at a central clearing platform. So as a result, the CCPs, the payment settlement systems, central counterparties, they will become very big. So, they become systemically important. So you need to regulate and strengthen, the financial market infrastructure institutions like CCPs more effectively. Another area relating to securities market which was thrown up during the time of crisis was money market funds. There was a run on some of the funds in US. The fund was holding assets of Lehman Brothers, and we know what happened. Lehman Brothers collapsed, and there was a run on those funds. Now, the question is, how have we fared in India against this global push in the securities market area? As Dr. Krishnan and Dr. Ela have already talked about it, so that makes my job easier. In terms of our regulation of systemic risk and perimeter of regulation, we have a similar structure as it is in many parts of the world, like US, UK, and other places. We have a council called FSDC and FSDC subcommittee. FSDC is Financial Sector Development Council, which is chaired by Finance Minister, and FSDC subcommittee is chaired by RBI Governor. To my understanding, the arrangement has been working pretty well, and all the regulators are part of this. There are some groups as a part of this structure. You have inter-regulatory technical group, and you have early warning group. These groups typically, look at how to enhance regulatory coordination and also try and spot early warning signals, look at, the problems which are brewing in some sectors which are not getting enough attention, etc. As a part of FSDC subcommittee, an exercise has been done where we've tried to identify financial conglomerates who have interests in all the segments of financial assets like banking, insurance, mutual funds, and all the regulators, meaning RBI, SEBI, IRDA, and they have signed an MOU for supervision of these financial conglomerates, and they meet once in a while. And the idea is to see, just keep a watch on these 12, and the number of conglomerates which have been identified is 12, and there is a lead regulator concept. So if in case the financial assets in mutual fund space are very high, SEBI would be the lead regulator for that. And the idea is to keep a watch and do whatever is required to be done. In terms of the review of regulatory perimeter, I can inform you that SEBI has been quite proactive, and we have brought within our regulatory ambit a number of players who were not earlier regulated. For example, research analysts, investment advisors, and alternative investment funds, which include hedge funds, which is a kind of a light touch regime. And very importantly, let me talk a bit about the CRA, Credit Rating Agency regulations. I think India is perhaps perhaps the only country which had regulations for CRAs since 1999. And that time, the Western world looked at us with some suspicion. Credit rating is, it's an opinion. So how can you regulate opinion? That was the basic argument. But nonetheless, we had a kind of a light touch regime for CRAs. And after the crisis, we've strengthened that, the regulatory regime in terms of bringing more transparency, more disclosure requirements, and addressing the conflict of interest issues. Again, on the auditor side, we have strengthened corporate governance norms. We had a Satyam case in 2008, and where there were instances of huge amount of insider trading, market manipulation, auditors' connivance, and the action is still going on. As a result of that, some steps were taken, and the auditors' regulation has been further strengthened. But let me say that, in my personal view, that in terms of oversight of auditors in our country, we still have some way to go. My view is there is a need for an independent oversight by an independent body, which is missing. There is a talk of NFRA, National Financial Reporting Agency, but we still have to see how it comes up. OTC derivatives, luckily in securities market, we never allowed that, so we didn't have that problem. RBI does allow, OTC derivatives in the area of interest rates and currency. FMI reforms, very quickly, we are on track. We are following the global principles, and our CCPs are, well managed. I think I can skip this in the interest of time. Just to give you the major securities market reforms. A bit of digression here. Not all of these reforms are related to the crisis. So if you look at the red letters like PIT, Securities Law Amendment, and new Takeover Regulations, these are the reforms intended to strengthen the regulatory powers. Just to give you an example, our insider trading norms, the previous regulations were more than a decade old, so there was a need to bring it, to revamp it. One option was we could have made some marginal amendments, but we decided to revisit the entire gamut of regulations, and we've come up with the new regulations which have become effective recently, and it completely overrides the previous piece of regulation. So the idea is that as a proactive regulator, we have to keep changing our toolbox in tune with the market developments. Similarly, new takeover regulations, we completely overwrote the previous takeover regulation by the new one few years back. Again, perhaps in the interest of time, I will move on. But idea of this slide is basically to give you a sense, we've come a long way from 92, 93. We started with automated screen-based trading, which was way back in 94, 95. And if I can talk recently, 2015, we are trying with new ideas where, we've come up with a new framework just to encourage innovation also in the market. We have come up with a regime for startups. We've interacted with the startups in Bangalore, and in consultation with them, we've come up with a new framework. So there's a wide gamut, but I perhaps cannot cover all of this. So let me move on. Now let me talk about three clear trends, from the securities market perspective, post GFC. One is, world over, we are finding enhanced enforcement. Second is, my sense is, at the G20 FSB level, lot of policy work is nearing the completion. So now the shift is towards monitoring of the reforms. And third is, it is giving rise to a lot of cross-border concerns. So I'll take up each one of these. So if you look at, I picked up 3 markets from their annual reports, we collated the data. So if you look at US SEC, in 2010, the penalties were 2.8 billion, which has gone up to 4.1 billion in financial year 2013-14. In 5 years' time, you see a 50% jump, perhaps more than that. SFC Hong Kong, 25.4, and which went up to 62.8, more than doubled. In case of FCA, and I'll explain in a minute why the numbers are so huge, FCA UK, it is from 89 million pounds, it has gone up to 1471 million pounds, and the main reason is that they had a benchmark crisis, and that's another interesting part, I don't think we learned enough from the global financial crisis. Maybe you learned in certain sectors, but the lessons that you learned did not travel across the organization. So, you had problems, huge problems in the benchmark side, where, the interest rates and the currency were sort of manipulated. So, this is a result, as a result, you have huge, a penalty. So, this is one trend. This is just, how the LIBOR fines have panned out, but I need not. Another trend is, there's a focus on individuals, not just the firms. If you look at, in US, the fines have been so huge that the firms have started taking it as a cost of doing business. You could get into the consent proceedings and, you could pay off and keep on working. So it was kind of, the effect of penalty was not exactly being felt. So as a result, there's a focus on individuals. More and more individuals are like CFOs, CEOs, etc. So this slide shows in how in different jurisdictions, the enforcement against individuals have gone up. In the interest of time, again, I'll not go into the details. Now, where do we stand in SEBI? If you look at our investigations, this slide gives you the numbers. In the last 3 years, our trend has been 74 investigations completed, 119, 120, and so on. Similarly, we have also tried to enhance our penalties. Our penalties used to be inadequate, and now, this slide gives you a sense how in 12-13, our penalties were only 40 odd crores, which went up to 135 crores next year. Very quickly, as I said, another trend is increased focus on implementation monitoring. So these are the tools: thematic reviews, country reviews, progress reports, monitoring surveys, and all the players like IMF, FSB, BCBS, ISCO, IAIS, they're all playing important role in this. Very quickly, what are maybe I'll just talk about one of the cross-border concerns. What is typically happening is there is a bit of over-regulation everywhere, and over-regulation is actually being felt across the border. For example, in Europe, you have European Market Infrastructure Regulation, where they want the CCPs, the central counterparties, where the trades are cleared, they should be recognized by the European regulators. If these CCPs want to clear the trades of